Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is September 9th, 2012 edition of Market Outlook. Please be sure to sign up for our investor sentiment survey and we'll send you the results. Furthermore, if you would like to receive this video update every week, please sign up on the website and you'll get this for free on a weekly basis. So, markets are at an interesting spot. Some of the highest levels we've seen in over a decade in some indices, and over in 5 years in others. So in the S&P, taking a look, you can see that we had this nice level of consolidation throughout the month of August, and finally, on return from the long holiday, markets responded, moved up quite sharply, up to new highs and up several percent on the week. Interestingly enough, we're running a little rich, but not that rich on a relative strength basis on the daily charts. And you can see we are now moved out of this channel. We can actually redraw the channel that we had in this way. And so we still have plenty more potential on the upside, and again, not overbought. Now the good news is that the market has actually on the up days responded with higher than average volume. So you've had a couple of accumulation days in the last couple of weeks, all on greater volume than the 50-day moving average, which is a good confirming sign. So there is some volume coming back into the markets. Obviously, on an absolute level, we've been really dropping off. Hopefully, this is a good sign that there is some money flowing back into the equities markets. On a weekly basis, same type of scenario. As you can see, low weekly volume has really predominated. If you look at this yellow line here, that's the weekly average of volume. We've been trading well under it for virtually all of 2012 and even dropping off severely. So we're also not overbought on a weekly basis. So there's plenty more room to move in the U.S. equities markets to the upside on a price basis. Let's take a look at the volatility index. Well, this sentiment index here, you can see we got overbought early this week. And when we got at the upper end of the Bollinger Band and moved back inside, that was a buy signal. And so the buy signal actually worked like clockwork. We're now back into the middle of the Bollinger Band, so we're not showing any excess sentiment either way. It's now under the 50-day moving average, under the 200, in the middle of the Bollinger Band. So sentiment is positive and indicates further continuation to the upside in the trend. You can say the same thing on a weekly basis. Looking at the weekly charts in the VIX, is we are under the longer term and the shorter term moving averages, as well as in the middle range of the band. So sentiment is positive and indicates also no trouble looking out on a longer term basis. Let's take at some of the market indicators. Back in mid-July or late July, we had a McClellan oscillator, which is our intermediate term 1 to 3 week oscillator, indicate that the market was oversold and actually has taken its time, but has actually worked its way higher. Now, what's interesting is, again, plenty more on the upside. So we are not at overbought readings on an intermediate term basis at all. So with this rally can still continue based on our market internal readings on an intermediate term basis as well. Now, shorter term, looking at advanced declines and up-down volume, you've got a scenario where the advanced declines are very strong. You've got very few stocks moving down, everything sort of moving in tandem pretty much to the upside. So we're at high levels, but it can certainly get higher. And until we turn back down and move through this minus plus 2,000 level on the advanced decline, it will not be a sell signal. In addition, volume still needs to kick in. So we're certainly not overbought on a volume basis. And again, plenty more room to move either way. But all this suggests that we're not running all that rich on price and market internals for the U.S. equities market. Let's take a look at TLTs. Okay, in TLT you can see on the daily charts that interest rates are locked into a trading range between a declining 50-day moving average and a rising 200-day. Now, as you know, when the market had made its new high here, we were very, very suspect. It was overbought. It actually made new highs on very, very light volume, and you got a subsequent nice sell-off. We also indicated that the 200-day moving average, which is this thick green line here, was a good opportunity to cover at least a portion, if not all of your position, which we did. We covered a portion of our positions here and have stayed with that bet that there's a potential top in long-term rates forming. So right now, as expected, we thought the market could bounce back up to its 50-day moving average. It did. It was now rejected. And in fact, you had a perfect Fibonacci retracement of almost 61 to 62% from here to here to here, which is a perfect Fibonacci retracement up to that 127 or 128 level. So we back down here to 124. Now it's also interesting to note that even with the market moving higher based on potential further Fed easing or QE3, that the market initially gapped up indicating lower rates and then completely fell apart by the end of the day. So is this long-term trend getting tired? Certainly a possibility. If we can get through this 200-day moving average and break through convincingly, it could be that this whole thing here is the top that we've been potentially looking for. Okay, taking a look at a market sector. Interestingly enough, home builders continue to outperform most other groups. It's one of the strongest groups on the board. This is a chart that I want to take a close look at. Basically, we've got a weekly closing basis chart in XHB, which is home builders, INX, which is the cash index here. And what the chart on the bottom is a ratio chart or a ratio spread chart. And as you can see, when the red line moves up, certainly above this green, which is a 20-week moving average of the spread, the relationship between home builders and the underlying S&P index, you can see how we've been outperforming. And interestingly enough, with the market up, it also continued to outperform this week. So home builders is still an extremely strong sector to watch. So the next thing I want to cover is gold and silver. As you can see, similar chart here. Gold has broken out from its sideways action in the last several months. This is a huge wedge formation that we broke out of. Same thing for silver. Interestingly enough, the similar ratio chart between gold and silver indicates that silver is going to be the strongest mover out of the gate here and on a continued basis in the precious metals group. Now, if we look at gold on a price basis and RSI, you can see we're trading at 98.48 on the daily RSI and over 98 on the weekly RSI. Now, does that mean things can't get more overbought? Absolutely not. But wouldn't be surprised to see some sideways or corrective action, or even a potential throwback and another test of the breakout of that wedge formation. So certainly possible to see a potential retracement here. A lot's going to depend on those interest rates and that chart, because this market is definitely anticipating another round of easing by the ECB and the Federal Reserve. So if we get that, you can expect a breakout of this wedge, this or pennant formation, and you're talking about a count to well over $2,000 in GLD. Well, that wraps it up for now. We're certainly living in an interesting time, and the sideways action and the breakout this week in these markets certainly indicate further price momentum and activity. So stay frosty and look forward to seeing you next week. Thanks, and bye for now.